monetary policy decision coming up at 2:30 this afternoon. I'd call it a big event, except that most are expecting that it will be a bit of a non-event. Nevertheless, lots behind that decision to discuss, even if the monetary policy chooses to keep interest rates unchanged. Joining us to speak about some of that is Manish Wadhawan, MD and Head of Rates at HSBC India. Manish, good morning. Great to have you here today on Bloomberg Quint. Manish, there's a small constituency which is continuing to argue that a rate cut, at least one last rate cut in this cycle, is possible. What's your sense? What are the arguments for and against?
I have my doubts about a rate cut today. I think it's going to be quite a neutral policy. I don't want to call it a non-event. It's going to be a very, very important, I would say, event for financial markets, because it will lay down the ground for 2018 expectations in terms of monetary policy settings. I think the key to see is that in the last 2 months over the last policy and where we stand now between October and December, the financial conditions have actually tightened quite a lot in the sense that liquidity has come to a neutral kind of a stage in terms of what we measure as the amount being given to RBI or maybe lent or borrowed by the banks. It is falling between that 1% plus minus 1%. So, and the bond yields, if you look at it, the yield curves have moved up from 30 to 40 basis points across board, means yields have tightened already. I think that is the key where we are looking at today, that markets have already started factoring in a mild tightness in terms of what RBI has implemented. You might see a neutral policy today, and they might lay down some kind of a glide path for the future. I think the next thing which we are supposed to look at, which will be important for us to look at, is if they revise the growth and the inflation projections again. So I think these would be the factors which we'll have to look at. But the underlying markets yields have already firmed up quite a lot in the last 2 months.
Manish, explain that liquidity situation to us a little bit more. And, we had the Bloomberg Intelligence Banking Liquidity Indicator up on the screen while you were talking. So we have seen considerable tightening, say, over the last few months or so, but we are still in surplus mode. What is the market's expectation that as you get towards January to March, and if the government were to increase borrowings, that liquidity would come to neutral and perhaps even deficit?
Okay, to give a perspective, if we go back 1 year when the demonetization happened, and post that we had a surplus liquidity to the extent of something like 7 to 7.5 trillion INR in the system, which means the banks were lending to RBI. Those numbers have dwindled to something like 40 to 50,000 crores in the last few days. And in the month of December, you might see actually the banking system borrowing from RBI. That means it will completely reverse. That could be temporary because of the advance tax outflows at that point of time. But the point which I'm making is the currency with public, whatever had come in at the post-demonetization phase, the remonetization has completely taken over, and now we are sitting at a neutral level. Second thing is RBI conducted OMOs worth 90,000 crores during this fiscal starting from May, June. I think that's the important message. They might not be talking about it in the policy, but the actions are clearly telling you that they've sucked out that liquidity. That is countering the FX reserves which they built up, but they didn't allow the liquidity to build up. By December, we should have a situation where the banking system could be borrowing around a trillion or lending just a very small kind of an amount. And Jan to March, you would see a phase where liquidity tightens on its own because of other factors. The government balances go up. In the sense, the central government balances start going up because they've already spent nearly full of the fiscal. So the monetary conditions which are measured in terms of LAF, what we say, which the banking system is either borrowing or lending, are already at a neutral stage. There could be a situation where the banking system might need to borrow. That is what I meant, that the liquidity conditions have tightened quite a lot.
So what would the market like to hear from the RBI? I mean, they wouldn't put it in the statement perhaps, but in the press conference later, would you, if there's any commitment that they are not intending to restart OMOs, would that be enough? Would you, want to hear them talk a little bit about the intention to maintain surplus liquidity? What would the market want to hear, Manish?
I think the key thing would be what do they talk about inflation projections and growth projections? Because last policy, they revised the projections in terms of growth to 6.7. Whether that gets revised downwards, because now we have 2 quarters of numbers. So effectively, we need a 7.5% plus for both the next quarters to reach that 6.7. And other thing is the inflation projections are between 4.2 to 4.6 for the whole year. There is a possibility that it might get revised upwards a bit. Why is it happening is because we have seen the commodity prices, the oil prices have gone up something like 30 to 40% in the last 4 or 5 months. It will have the cost push inflation factor, which is hurting somewhere the inflation projections. Also, in addition to that, I use the word, there is a fiscal push in some form of tax cuts, etc., which the government is trying to achieve. So it could actually lead to a higher inflation number, and the growth might be, kept at the similar kind of levels. So if you put all these things together, hoping a rate cut, I don't think so. It actually might show you a glide path that if the inflation goes up beyond this number, they might have to even tighten the monetary policy. The underlying conditions in the global markets is also getting towards tightening. We have seen the first rate hike in Asia from Korea. And if we look at our peers, what is happening in the Asian world, the emerging markets, everywhere the small tightening is happening. In China, the rates have gone up something like 70, 80 basis points in the last 1 year. 2017 has seen uptick in yields of around 70 to 80 basis points. I think putting everything together, what I sense is today is going to be a neutral policy. Today is going to be just accepting that whatever we had projected, we are just chugging along. And no action I expect from RBI today. I think the glide path would start from February or April. In terms of liquidity, I do not expect anything explicit from RBI, whether in form of OMO or even saying that whether they'll keep a liquidity tight or whatever. They are, I think, trying to make the market accept to this fact that we have turned towards a neutral policy, and so accordingly the liquidity is being manipulated here.
Okay. Manish, one more question from me and then I'll turn it over to my colleagues. The steepening of the yield curve, what is it reflecting? Is it reflecting an expectation that perhaps in the second half of 2018 we'll start to see rate hikes? There was a call from Morgan saying that perhaps in the second half of next fiscal, that is, you could see a rate hike, or is it reflecting more the liquidity condition right now?
Combination of both, I would say. It's the demand supply dynamics in the market which plays a role. So, if you look at the central government borrowing numbers, they've been flat for last 3 years now. But the missing point is the state government borrowing has more than doubled in the last 3 years. From a borrowing of around something like 2,25,000 crores, this year they're going to be borrowing something like 4,50,000 crores. So that also pushes up the yields at the longer end because there's a lot of supply. But beyond that, I think what you said, at the moment, if you put 2 and 2 together, if the growth is actually going to pick up from here and we are seeing traction in form of inflation also, then there is a possibility that RBI might have to hike. But I think it's too early to judge those kind of things. Yes, market has, at least in the prices today or in the yield curve today, have taken away a rate cut from the table. So if anything of that sort happens, that will be a real big surprise today if the hint is towards a rate cut. But yes, market has come to a neutral zone, and then wait and watch for the next 3 to 6 months how it pans out.
Manish, I have a quick question here. This is Menaka, and it's a question more from a consumer point of view. You've spoken considerably of the liquidity tightening. Just wondering if at all there is the slimmest chance that could feed into higher lending rates at all at the retail level?
Menaka, I think that might not happen in the next 3 to 6 months. Where I'm coming from is if you look at the credit data at the moment, the credit growth is not more than 6.7 or 7% as per the latest data available. Till the time we see actual genuine demand of funds increasing from on account of credit from individuals and from the industrial sector, I don't think so that will happen. It's more of an adjustment of repo rate at 6%, and then you accordingly have a government securities curve, a GSEC curve, what we talk about. But lending rates in form of housing finance, etc., at 8.25 or 8.30 or 8.5, I don't see a pressure, anything of that sort, at least for the next 6 months. So that is something which we'll have a cue only in April policy we'll have an idea. I don't think so we are heading towards any kind of a massive tightening from RBI or anything of that sort. We have come back to some kind of a neutrality in terms of what we saw because of demonetization. That has fully reversed. So that is what, but I don't see any major kind of a reaction in lending rates for the next 3 to 6 months at least.
Okay, and I suppose by the same extension of logic, that would apply to, let's say, deposit rates as well, right? Even though we've seen some very minor hardening in deposit rates for bulk deposits, we would not expect at the retail level for banks to want to be able to attract more money, a higher rate of interest at all.
Now, Menika, a very pertinent point what you have raised. You know, we have been debating about it and putting numbers together. An interesting fact comes out. As of today, the credit to deposit ratio is hovering around something like 68%. And if you include other accommodation from the banking system and NBFCs, it is around 75%. If genuinely you believe that growth is going to pick up and the demand for money, demand for credit is going to pick up, then you actually might see some kind of an uptick in deposit rates also, because the deposit creation in the system has been very, very slow. So it's like a chicken and egg situation. If the growth starts picking up from here, you actually might see banks raising deposit rates because you would be needing more deposits to satiate the demand for credit. At the moment, we are sitting on a fence, and deposit rates have been reduced to the extent whatever they could. We have seen the evidence, as you mentioned, the bulk deposit rates from the largest public sector bank were raised by 100 basis points because the interbank liquidity has become tight. So I would actually say we are at a neutral stage. If genuinely growth is going to pick up and credit demand picks up next year as is expected, and the world economies are doing better, the data, whatever we are getting from everywhere, then you actually might see deposit rates also inching up a bit in the next year.
All right, Manish, thanks very much for clarifying that.
Last question from me, Manish. What's the call on the 10-year? How far do you think the yield can go? Building in the possibility of increased borrowings from the government in Jan to March, and also what's the number doing the rounds in the market as to how much the increased borrowing could be?
See, frankly, that's a big black hole era. The reason why I'm saying so is the numbers in terms of the government revenues are still not clear for the last 3 months. Means they have not been updated on the CJ website. So we are really not clear about it. How is it going? But if we go by the GST collections, whatever are being published in the press, there might be some kind of an additional borrowing which may not be market disruptive. So I'm not fearing that it's going to be a large extra borrowing coming in the month of January. Those auctions which have been slated for 5,000 crores each could get adjusted by something more by, every auction could become 10,000. So extra borrowing of 20, 25, 30,000 crores, which can be easily absorbed in the system. So that's not a worry. Sorry, I missed your second point. What
the 10-year yield, just wondering how far the 10-year yield can go in your estimates.
Yeah, see the 10-year, yeah, sure. 10-year yield has moved from around 660 levels to 705 now. I don't think we are going to see a massive further upside in yields. For the balance, I think next few months, what we're talking about, we've already readjusted to a new level. We should be hovering around these levels only, unless and until we see a massive surprise on inflation. Otherwise, I think fiscal side, and just to add to one more point, I think the government is getting a lot of collections in form of small savings, which would be used by the central government itself. So that is also one of the reasons that we do not expect that extra government borrowings could be very large. I think 10-year yield will hover around 10-15 basis points from these levels. I don't expect a massive rally to go to 6.5% or a massive sell-off to 7.5%. We are already we've factored in all these new things which are happening in the system, the tightening of liquidity, the higher inflation numbers, and not to forget the growth numbers which are getting under question or lower. The second quarter has also not been too great. So we have to balance it out. I expect quite stable markets for the next few months at least.
All right, let's hope so. It's been a turbulent year, Manish. Thanks so much. Always a pleasure to speak to you. Appreciate you joining us here on this policy conversation.